Welcome to Disruption Blueprint. Today's episode is all about ownership, optionality, and the future of independence in wealth management. I'm joined by Louis Diamond, CEO of Diamond Consultants, whose firm has advised on more than $350 billion in advisor transitions and has been at the very center of some of the industry's most transformative advisor moves. We're digging into what's really driving the acceleration towards independence, why seasoned advisors are rethinking enterprise value and control, and how AI is beginning to reshape everything from advisor productivity to transition friction itself. This conversation goes far beyond recruiting trends. It's what advisors should be building for the next decade, how to think like a business owner, how to future-proof your firm, and why the combination of human connection and technology is becoming the defining competitive advantage in wealth management. Let's jump in.
Welcome to Disruption Blueprint with Shannon Spotswood from RFG Advisory. In this podcast, we help advisors grow their net worth, build their businesses, and maximize their independence. We've built an award-winning platform with innovative technology, comprehensive service, and a team of individuals who are experts in their field to serve advisors. Join us for this journey where we explore everything that has to do with running an independent advisor practice as we bring together successful advisors, industry experts, and innovative minds who are on the bleeding edge to challenge the status quo, foster new ideas, and create a path for advisors to unleash their growth potential. Now, on to the show.
Welcome to Disruption Blueprint. I am so fired up for this conversation. I am joined today with Louis Diamond, CEO of Diamond Consultants. Welcome to the podcast, Louis.
Thanks, Shannon. Excited to be here.
So you've got some pretty impressive stats behind your firm. Obviously, you're one of the most well-respected recruiting firms and consulting firms in the country. But what really jumped off the page is that you've helped transition over $350 billion in assets, and your firm has played a key role in 25% of the billion-dollar plus moves that have happened in this country. It's just incredible. Congratulations.
Thank you. No, I appreciate it. Yeah, it's been 30 years in the making. I had the easy job of stepping into a business that my mom, Mindy, founded. So my job, I guess, is just to not mess it up.
I always love, when you hear the history and stories, because it truly is like it was an overnight success that took 30 years to get there. I mean, that's how great businesses are built.
Exactly. It's like I've seen like the meme before where it's like a iceberg where like people see like the top of the iceberg, but you don't understand like what's beneath it. I think it's the case with every business. So yeah, I try not to get jaded about the fact that the foundation was really the hard part to build, and we're just grateful for the trust that all these amazing advisors have put into us, and also grateful for the industry. Yeah. I mean, it's such a cool and dynamic industry, which we'll talk about, and all the options, all the innovation, all the capital, basically just makes my job a little bit easier every day.
Well, absolutely. And, I share your passion for our industry and certainly for the move to independence. So today we're going to talk about independence. We're going to talk about AI. We're going to talk about trends. You all recently dropped your annual report on recruiting and deals and transitions, which I know everyone really looks forward to. And this one this year really kind of just like, wow, caught my attention. 11,217 advisors made a move. That is an uptick of 16% growth year over year. Just incredible momentum. But what was really so just thought-provoking was that the average tenure of an advisor who moved was 22 years in the business. So again, overnight success, 22 years in the making. So something has fundamentally shifted. So I would love to hear your thoughts on the report, on the increase in transitions, and then this like the seasoned veterans are making a pretty bold prediction with the movement on the street.
Absolutely. Well, first, thank you for calling it out. I can't take credit at all for the report. My brother Jason is the the data minder and the author of the report. So it's a collaborative effort, but the credit for making it happen goes to him. But obviously, we put our company's name on it. But yeah, relative to the report, I agree with you. Honestly, most people call out the number of advisors moving. You definitely read the report, and that I think is an incredibly astute observation of the report. Was the average length of service that an advisor had who moved? Because I think there's a narrative oftentimes that like the people who move, like they don't have a book, they're super tiny, they don't have that much to lose. But this clearly indicates that it's folks that are in kind of right in the sweet spot, right in the strike zone of their career. Like they're probably in like the peak of their growth curve. They do have a lot to lose by moving, but they still are. So I think that you're very smart to pull that out. We also, what's notable, I think for the same reason, we strip out of the report any advisor who has length of service less than 3 years. Because I'm not going to name names, but there's some firms in the industry, some big firms who lose advisors, but then they'll recruit someone over without a book or put them into a bank branch, et cetera. And to me, that kind of washes out the real narrative, which is the longer tenured, more successful advisors are the ones moving. And if you lose a $2 billion team with 4 advisors, if you're just tracking headcount, hiring 4 folks without a book looks the same.
Right.
So that's what we try to capture. And yeah, last year was active. I mean, it was, I think part of it was probably 2024 was maybe a little bit of a down year. And last year was, I think, more of a normal kind of baseline. There were some kind of fluffing of the numbers. We had LPL's acquisition of Commonwealth. Like obviously there's a lot of movement from UBS, but it seems like every year you have that like one like major contributing event. Last year happened to be LPL Commonwealth. This year it's going to be 5 things that we have no idea about. But I think it does show that advisors have choices. Advisors who are confident in themselves and their future are willing to push their chips to the middle of the table and take control over their careers. And we're all benefiting from this movement and kind of dislocation in the market.
Let's double click on that a little bit, because given the tenure, has there been a true dot connecting on the value that these firms are commanding in the independent space, the recognition of, owning, the language that we use at RFG is owning that enterprise value on your family's balance sheet? How much of that now is just like commonplace, like advisors have become more aware and more, just more sensitive to the upside that they're giving up by not making the move?
Yeah, I think it's a great point. I mean, we always say like one of like the fundamental shifts in advisors in general is the mindset shift. Has been the fundamental shift from I have a book of business, I'm an employee of XYZ firm, to really thinking of their business as a business and not a practice. So that's been the last number of years. I think that was kind of like the seedling that kind of started the breakaway movement from the big firms to independents. Still though, even though I would say advisors are much more tuned into the immense value that's locked up in their business, they understand multiples better. They understand that there's buyers for these businesses. Many understand that a recruiting deal is oftentimes not the best deal, not the most tax efficient, not the best long-term play, but still more than 50% of the time, advisors who are in transition, they move within their channel, meaning they move from UBS to Merrill or Morgan Stanley, or they move from Cetera to LPL or Raymond James, or they move between XYZ RIA and another RIA. So even though all of that is there, there's still plenty of advisors who either are, we'll say, like playing more of the short-term game, nothing wrong with that, or are kind of going towards the path of least resistance. But the most exciting teams we work with, the most transformative moves we see in the industry, are advisors who wake up and say, hey, I really am a business person. I might be a business person cloaked in an employee's garb, but I want to call the shots. I want to own my own equity. I want to control my own destiny. And if I do make a move, anything else feels lateral. I want to take control over my own destiny, own the business, have something of value. And we've seen it. I mean, the real way to riches in this country, not just within our industry, is business ownership and transacting business value. I think every advisor can attest to that.
Well, one of the things that when I'm talking to advisors about this, that I always point out is never lose sight of where the asset truly resides. The asset is the trusted relationship that has been built usually over multiple years, if not decades, between the advisor and the client. So whether it's RFG or any of our, our formidable competitors, I mean, we have such an incredible ecosystem that advisors have the opportunity to partner with and choose from. But I always double click on that point for them, because that to me is the fundamental first principle of why do I want to be a business owner? Why do I want to flex my entrepreneurial muscle? Is because the asset is not in the tech stack or the workflows or in all of the custody relationships. Like the asset is in that intangible, that client experience. How do you build that deep trust? I mean, it's the advisor who gets the call on Sunday night when there's a crisis in the family or a pending business sale. Like, that's where the asset lies. Like, maximize it.
I agree with you. Yeah, I mean, that's an interesting way to frame it. I mean, obviously it's all interconnected, right? If you have to be a steward of that asset as well, just like you have to be a steward for your client's well-being and be a fiduciary, et cetera. But part of it is, do I have the right tech stack? Do I have the right custodian? Am I doing all I can to maximize the value of this asset? I mean, sometimes, and you know this better than anyone, like advisors, they get really hung up on the payout. Like, hey, I'm getting 92% with a 4 basis point admin fee today. So why would it make sense that I get an 85% payout? Like, I don't want to move and make less. But really, it kind of buries the lead, which is you go where you think you can grow the fastest. If you can grow an extra 5% per year on this platform over another, that compounding value is going to pay off in spades. And ultimately, that's what you're building towards. I mean, it's nice to make a bunch of money now, but for a lot of advisors, the goal is to maximize their long-term value and have something insanely valuable that they can sell at day's end. And to me, the decision of what platform or what version of independence that you decide it could be a blocker of value, right? Like the firm gets in your way, they're slow to respond to technology change or AI. They don't let me have an OBA. They don't let me market myself the way I want to, or they can be a massive enabler. Credit to RFG. I know you didn't pay me or prompt me to say this, but I think the fundamental belief, which you back up with data, that advisors who are focused on investments are going to grow slower. And that advisors who aren't investing in marketing and branding are going to grow slower. Like, you've really cracked the code on growth. And I do think a lot of advisors sometimes miss the forest through the trees, which is go where you can grow the fastest, grow where you're going to be the most excited, grow where you can serve your clients best, or go where you can serve clients best. The payout is kind of just like, it's a data point, but it shouldn't be an initial gating factor or the entire decision that someone's making.
Well, I so appreciate you saying that, because it is obviously at the core of everything that we do is help independent advisors build their business without compromise by driving organic growth. We think it's so important by driving organic growth to create enterprise value. And that is the X factor. That is what is unlocking all of this enterprise value is, can you tap into your superpower, which is serving these clients, delivering this exceptional value proposition through that experience. And the only way that you do that is having synchronicity within your tech stack, to your marketing, to your ops, to your compliance, and to investment management. And right now we're at such an interesting time in our industry, because you've got the data telling us, the demand for advice is surging by 30%. The number of advisors is decreasing by 0.2%. The consumer is saying, I want to work with an advisor, but I want it to look different. I want it to feel different. I expect more out of that relationship. So we are at a crossroads for those advisors that, to use your phrase, push all the chips into the middle of the table and build that firm around them to be, future-proofed, are going to see and unlock more value than I think we could even begin to imagine today.
I completely agree. And to me, it's like you're controlling what you can control. Like no one can control what are multiples going to be like in 5 years. No one can control, is there some like crazy AI innovation, which there is, that we're not seeing now that's going to fundamentally change the business. You can't control that. Can you control how long your clients are with you? Yes and no. What you can control is what intentional actions am I taking today to continue to grow my business and support its value? And I think you would probably agree, no matter where multiples are, whenever someone wants to transact, the businesses that can grow organically outside of market appreciation, they get a higher value. And that's ultimately what you're able to control in the market. And then you can decide, is the multiple high enough? Is the valuation high enough? Is it the right fit for me? But if you make those intentional actions, you can kind of punch your ticket to wherever you want to go to on this crazy train that's an advisor's career.
Yeah. I want to come back to, you were sharing some numbers about, I've got a 92% payout and a 4 basis point admin fee. I always, kind of tilt my head a little bit because I oftentimes think that advisors aren't great at doing their own math on their own business. So those numbers really sound great as a headline. But then when I always ask the follow-up question of what's the dollar amount that gets deposited into your bank account, those numbers are not anywhere close to kind of the headline. But that's the economics, and we can all run, pro formas and all the rest of it to analyze it. But what I think is such a critical piece that is not appreciated when advisors are thinking about top line economics is the gross misappropriation of their time and their team's time. And they are willing to accept for, we're all capitalists here. Like, everyone's trying to run and grow a business that's generating a profit. So if I am receiving these very high payouts, I am giving up something for it, whether it is, non-compensatory revenue that's being earned on the back of my client's book, or I'm allowing for my team to, make 15 different phone calls to try and get one answer that they really like. Yep. And what's so interesting to me about it is that the advisor, you talk to 100 advisors will tell you the exact same thing. The most important thing to them is, are their clients being taken care of? That's what they obsess over. Are my clients being taken care of? If you're having a succession agreement conversation, it's the very first question. What will be the experience for my clients? If you're talking to an advisor transitioning, what will be the impact to my clients? And yet, so they're fiercely and righteously so defending and in pursuit of the best possible experience for their clients. But for their own business, they're willing to accept something just incredibly subpar. Such a disconnect.
I agree with you. I mean, it's kind of like, and I'm going to say this, and no shade against people that do this, but it's almost like going grocery shopping at Walmart or going grocery shopping at Whole Foods. You'll get food, you'll get nutrients, you'll be able to feed your family either way. And for some people, one is perfectly good enough. But I think what you're talking about is are you willing to invest in a better, higher quality food product, or shop organic than using GMOs, to use a dumb example? I think it's kind of like that. It's like, that's the great thing for advisors is you have a number of different Walmarts that you can shop from. You got a bunch of different Whole Foods you can shop from. And if none of those are kind of floating your boat, then go and create your own food store.
Right.
That's the great thing is advisors can pick and choose which levers they're going to value most. And to me, it's incumbent upon firms like yours and your competitors to really connect the dots between, hey, this will be a better experience. You'll get better service. You can grow faster. You'll have more time. So I think that the critical link oftentimes, which is hard, it's much harder to deliver on and prove out than your payout's going to be this, which is just like the fact. It's a statement, is how do you kind of bridge the gap and make folks understand that that's the case? And for some, they may not believe it. They may be valuing different things. But I think people that really lean into this supportive independence ecosystem with firms like yours and others, that's what they're doing. They're reflexively choosing to play the long game and shop at Whole Foods instead of Walmart.
Yeah. You must spend and your team must spend a significant amount of time helping advisors understand, in particular, these big checks that are increasingly coming with clause in them. The timeframes are getting pushed out 10 years, 12 years. When you're having those conversations and when you're talking about it almost philosophically, how do you frame that up of, these are big numbers. I never want to discount it. $2 million, $3 million, $10 million. These are big numbers. I always, imagine you go home and you talk to your spouse and you're like, someone's willing to pay me $3 million today. Like those are
Yep.
those are emotionally charged and challenging and complex conversations. How do you help an advisor understand what they're trading away with these big checks, with these clauses, and what they're signing up for?
Yeah. I mean, honestly, the way I look at it is it's not my job to sell someone one way or the other, or to cast judgment on, hey, you want a big check to move. Like our job is to help them make the best possible decision based upon their own decision making criteria, like full stop. Um, honestly, it's hard. Like it's become harder for people like me, people like you, to overcome these big checks because they've gotten bigger. I mean, they're
Yeah.
up close to 50% since LPL announced their acquisition of Commonwealth. So it's hard when you say, hey, you can get 100, 125% of your GDC, make the same amount of money you were making, maybe a little bit more even, versus get a lower payout or get the same payout and get nothing today and instead
Right.
bank it on the future. So to me, like when advisors bring out their inevitable spreadsheet with flawed assumptions, and that's what it is. It's these models comparisons are garbage in, garbage out. If you're just looking at a spreadsheet, you're always going to pick the big deal
Yeah.
because just that's the way it works. What spreadsheets, et cetera, discount or don't, that it's not possible to take into account is what's going to be your growth factor if you don't take the big check, right?
Mm-hmm.
If you go start your own RIA, if you come to a firm like yours, it's hard to kind of put a number on that.
Yeah.
But I think people that are coming into the RIA world at the expense or the opportunity cost of a big check from a BD or another type of firm, they're putting a massive weighting on their ability to grow, on flexibility, on control, on not wanting to be told no,
Right.
on more autonomy to serve clients. And it's hard to put a number on that or
Mm-hmm.
quantify it. So it's more of like a gut feeling. But
Yeah.
I know, like, I've seen enough when an advisor is analyzing a spreadsheet, they're trying to reconcile, I can get like X payout from this firm with this deal versus nothing up front with 100% payout or whatever it is. Like the big deal is always going to win because it's going to take 3, 5, 7, 10 years to make up. But if you grow 5% more
Right.
per year, that the payback period is much lower. So it's definitely hard. So it's more so just helping them understand like what's driving the bus, what's motivating you. These were the 5 things you told me you were trying to solve for when we first started talking. Let's map that out. And for some people, it's, hey, like, I have a kid going to college and I've never monetized. And that's one of their 3 to 5
Yeah.
criteria. Fantastic. It's the folks that I think either see the bigger picture or who philosophically they want something more than what some of these firms can offer. That's the opportunity for me and for firms like yours.
We see across, the RFG network and partnership of organic growth north of 10%, like year in and year out. Firms that are really leaned in and wanting to grow or pushing that number even higher. So when we're running these pro formas, like we often
Yep.
see the inflection point is somewhere between year 2 and 3. Does
Yep.
that bear out with some of the analysis that you all are looking at?
I think it absolutely does. But like, again, when I see these like complex models that advisors create,
Right.
or when we're tasked with helping folks kind of do that type of cash flow analysis, unless the advisor agrees or buys into the fact that normally you're growing 5% per year. So the conservative answer is let's assume 5% growth if you go to X BD. Let's assume the same 5% growth if you go to Y RIA or launch your
Yeah.
own RIA. As long as that's the case, this math it's going to take a while
Yeah.
to make sense. It's someone who says, yes, I buy into this. I think
Right.
Shannon's awesome. And I buy into the fact that if I outsource investments to a killer team, I'm going to have an extra 40% of my time to go prospect or golf more. And that'll make
Yeah.
me happier and more creative. And I can tap into like a real marketing plan that isn't cookie cutter. Like someone has to really buy into that, but
Yeah.
it's on them to decide how they want to extrapolate that.
Yeah. All right. Let's turn to AI. Obviously, top of everybody's mind. We're
Yeah.
doing so many cool things. I've never been more energized. I keep the language I keep using with our team is this is a blue ocean moment. I
Yeah.
remember like my past career, I had this incredible chapter in San Francisco in the early mid 90s where I was working as an investment banker for a firm called Volpe Brown Whalen. And we took Netscape public, which was the first internet IPO, and that really put the firm on the map. And so I was sitting in drafting sessions, and it's so vivid in my mind, like, what is the internet? What is the World Wide Web? Like, I never thought I would see in my career again this like complete realignment of the economy, and it's a blue ocean moment. So AI is, the headlines are easy to come by, right? That both good and bad, whether it's, job losses, realignment of the way organizational design is being thought about. Or on the flip side, it's like everybody's juicing their stock price with the latest, greatest announcement of their partnership with Anthropic. So AI is really starting to feel like a push and pull factor, and is increasingly an important decision making moment for advisors. Like on that list of the top 5 things, having a well-articulated AI strategy that is dynamic and executable is going to be absolutely critical. So how fast is that dynamic starting to play out in conversations that you're having with advisors?
It's happening in real time, for sure. And I would completely agree with you. It's exactly the way I would describe it is AI has become, and it will only increase, been both a push factor, meaning a frustration. My firm isn't allowing me to use even ChatGPT as part of my day-to-day. It's blocked. Or the firm isn't really investing in their own proprietary AI. They're just kind of using some off-the-shelf stuff. That's the push factor, the pain point. But it's become one of the main things that advisors want to understand as a pull factor when they're evaluating different firms or platforms. I'd say right now it's kind of on par with like advisors want to do like a tech demo, right? Like they do a first meeting. Second step is usually let's see the tech, right? I want to see the planning software, the CRM, the performance reporting tool. How does it all work, et cetera? Now it's like AI is its own little fiefdom in it. But I think it's going to accelerate because we're quickly going to have the haves and have-nots. And I think some of it will depend on kind of what happens with AI, but also where firms and platforms are really able to drive change and use their scale to bring the best of AI to advisors. Like, I still think there will be advisors who say the best AI platform for me is one where I can choose what tools. I want to use Jump for meeting summaries, but I want that to be able to change in the future. Or I want to use this lead gen tool. I want to use this tax software. I want to use wealth.com for estate planning. Like, for some people, that might be their holy grail is I don't know what's going to happen with AI. Instead of backing one horse, I'll just keep it open, kind of keep it easy breezy. Versus others, which I think will be more popular, is it's freaking hard to integrate AI, to know what to stay on top of, to make it compliance ready, to make it actually save time. So I do think there'll be a premium paid for firms with scale that are out ahead developing AI. So instead of having to make another 50 decisions around AI, you make one decision.
Right.
I'm going to this firm, I'm going to this platform. And on top of CRM and planning software, et cetera, I get this amazing AI tool. And I trust that this partner or this platform is investing in the right things to stay ahead of it. So I don't have to. It's like outsourcing AI on steroids.
Yeah. It is. What's going to be so fascinating, I think there's two big things that are going to unfold with AI. I feel like, let's talk about 2026, like unfold in the next, call it, 8 or so months, because it is moving so quickly.
Which probably means like 1 month.
Exactly. The first is true business intelligence. Like, I am blown away. I always, the terminology that I use is like what we've got cooking in the lab, which is all the stuff that like we're working on. I am blown away at what we've been seeking this for 10 years at RFG, being able to deliver actionable business intelligence so an advisor really has a clear idea of not only what is the next best action, but how do I build those relationships with the next gen beneficiaries? How do I allocate my time to meet my growth goals? Like, all of this business intelligence is I think going to shine a very bright light on advisors spend 60% of their time on non-revenue generating activities.
Yep.
And if, Fidelity has done some great groundbreaking work on this. If an advisor allocates 10 hours of time intentionally to prospecting and serving their clients, coupled with a powerful AI tool, it translates into $570,000 worth of additional revenue for a $100 million advisor. Like, we're about ready to be living in the quantification of time in a very actionable way. So business intelligence is like stake in the ground. I think that's gonna shift a lot of behavior.
Yeah.
But I'm gonna put it out there to you that I think is the Trojan horse, which the number one barrier to exit for an advisor to making a transition is fear of the transition. Everybody's got PTSD either from their own experience or from their buddy's experience.
Yep.
It takes too long, the repapering, it's inconvenient, the clients, the rest of it. When we start being able to demonstrate transition after transition, whether it be protocol or restrictive or fully independent, and you can leverage AI and these tools to move books of business in less than a month, I'll go out there less than 15 days.
Wow.
I think all of a sudden advisors are going to be like, whoa, wait a minute. My single biggest barrier to not making a move just got knocked down. And that
No doubt
is going to keep your firm, my friend, very busy.
Yeah, I'm excited. If I was able to high five you right now physically, I would. It sounds reasonable, right? If everything else can move faster because of AI, like why can't transitions? You still have the fear factor of what if my client doesn't say yes, or what if I make the wrong decision, or I have 15% of my book is in proprietary alts that can't move. You still have that. There's no way around it. But I agree, it's chipping away at one of the. It's probably bigger than fear gap is the amount of backbreaking work and the disruption. So if you can credibly prove out that it's instead of 3 months, it's 15 days, it's 1 month. It's more time that clients are invested in the market. It's less time in advisors doing this work, more time with their families, invest in the business, et cetera. That 11,000 advisors in our report this year, I'm not going to say it goes to 22,000, but it's definitely going to be a lot more because I think that does knock down some of the barriers. The interesting thing, though, will be, okay, if this proves out over time, does this mean that firms are going to pay less in a recruiting deal because they feel like, in large part, a recruiting deal is meant to compensate an advisor for the risk. You're going to have some down earning months. Does the calculus become like, hey, you're only out of the market for a day, 2 days, whatever it is, and you're not really going to have any down earning months. We'll pay you something because we want to earn your business and it's a competitive market, but we don't feel compelled to give you as big of a deal as we once did because now with XYZ tool or innovation, that barrier is knocked down. So that could be like an interesting a ripple effect of this dynamic.
This is so interesting to think about. And as you were just sharing that, I was running through my mind just the organizational change that is coming to an advisor's business, like how their CSAs are going to be powered by this AI technology. You're removing friction from all of the day-to-day work of opening accounts and cashiering and trading and just the mechanics of this. They get to move into a higher impact role. What we always like to say is CSA should be force multipliers for their advisors. They do a lot of the frontline work with clients. So your triple down effect of like, oh, does that change the calculus of upfront money? Do these firms become more profitable as a result of being able to leverage this technology? They can serve more clients. They need fewer bodies in order to run their business. You start pulling on that thread, and it's going to get interesting.
Let me turn the microphone on you. We probably weren't expecting this, but let me ask you a question. So clearly you have a really interesting vantage point into AI and kind of where you perceive it to be going. How would you talk about I feel like with AI, it's both there's opportunity and there's risk for a business. So opportunity is more time with clients. Maybe I don't need to hire the fourth CA because I can move quicker. I can service more clients per advisor. I can transition my business faster. I can provide better insights to clients, et cetera. That's the positive. The downside is like AI starts being able to do financial plans, and it does rebalancing, and it does automatic direct indexing, like all these different
Yeah.
things. How would you kind of balance or weigh both the positive kind of upside improvements that AI brings, but being honest and weighing the downside and some of the systemic risks to financial advisors in general?
I think this is, circling back to what you were talking about earlier on the push and pull factor of AI.
Yep.
Those advisors that are not affiliated with a partner and in an ecosystem that are harnessing AI to be able to amplify their brand, double down on their client experience, have at their fingertips very robust technology for delivering information, communicating updates. Like
Yep.
they're not leaning into that, will be at a significant disadvantage. I think that we're going to actually see an acceleration of the number of advisors retiring sooner rather than later because they just don't want to deal with the dislocation that's coming in the market. But I do believe, and I feel very strongly about this, like highly convicted that AI is this incredible empowerment tool, and a human armed with the best version of it, which will be in constant state of dynamic change, will be able to have transformational positive impact on their client relationships. So man plus machine is more powerful than machine alone. And money is so much more, having spent the first 20 years of my career in like the institutional side as a hedge fund manager and living and breathing and like alpha and standard deviation and all the rest of it, like my, my initial love language. The computers have been good at that for a very long time. And there's no doubt that the younger generation jokingly, not jokingly, refers to Claude or Chat as their BFF. Like it is fully integrated into their life, and there's a high degree of trust placed in that. And yet, I think that the financial advisor, when I look across the entire spectrum of professional services, well beyond our industry, just like, where will you still want someone to hold your hand to help you make smart decisions in your career, start your business, plan multi-generational charitable giving strategies, like, and that human relationship is not going to be replaced by AI, but you better be ready to play. Because if you're showing up with yesterday's tech and all the BS, friction and nonsense, we are tripling down on this. And we think that RFG is in such a unique position, having invested 10 years to build incredible institutional depth in serving independent advisors, to harness the power of AI, to be able to be nimble and tap into creating and having the insights for, one of the things I'm most excited about AI, I gave, Jordan Hutchison, who's our VP of tech, the day he started, I gave him a little Fisher-Price toy, like a little Fisher-Price phone with the giant buttons. And I said, when we succeed delivering tech to advisors, it'll look like this. It'll just be there's such beauty in simplicity, and AI with the prompting and the business intelligence and the insights and the integrations, removing the friction from compliance, from ops, from paperwork, being able to harness the power of marketing. It's going to be it's going to be incredible. It's going to be incredible. So I'm very bullish on advisors.
I can tell. And it almost sounds like the shift is happening, but like faster. Is like investments were like the way advisors differentiated for years, is how they were compensated. It shifts to investments are commoditized. It's all about planning. And now when people say, like, you ask them, what's your differentiator? Financial planning. You're like, okay, everyone's doing that. So now it's almost like this is the next thing. Like if kind of a lot of the blocking and tackling of being an advisor is commoditized or stripped away from AI, what's left, the unique differentiator, is depth of relationship. It's like unique insights that only you have, and it's the service that you're able to provide to your end client. It's fascinating. I'm excited to see where it goes too. Like with anything, like things break, and there's risk, but got to break things in order
That's right.
to really enact change.
We've got two of my favorite quotes that we've turned into artwork around the office. One of them is, if you dislike change, you're going to dislike irrelevance even more. Or if you don't like change, you're going to not like irrelevance even more. And the other is, disruption and innovation are just two sides of the same coin.
I like that. Yep.
So it is, we're living it now. Okay. You mentioned earlier, and I've been dying to ask you about this, the LPL Commonwealth deal, like reshuffled the decks last year. It was kind of the like, whoa, nobody saw that coming. The ripple effects have had some pretty significant ramifications, both for BDs and for the IBDs and for the recruiting space and the rest of it. What do you think is next for these big firms? And when advisors are sitting there and they're like, okay, LPL's 30-something thousand advisors, they want to get to 50,000 advisors. What should they be asking themselves as it relates to some of this big deal making that's happening?
Yeah, I mean, it's like what's next? I mean, like on the one hand, I'll give you kind of the like both sides of the coin. Maybe not as eloquently as you said, disruption, innovation are two sides of the coin, but kind of similar. So on the one hand, if LPL is 30,000, 32,000 advisors, is it really going to feel that much different if they become 50 or 75,000? Like maybe not, right? They're already massive. You're already not calling up Rich Steinmeier when you have a question, and the conferences are already oversubscribed, et cetera. So there's that dynamic. It's like bigger. What's really the difference? The flip side of it is like scale is clearly like a big buzzword and has been, will continue to be. Like you need scale to spend billions of dollars on technology and stay ahead on AI, to hire the best people, to provide the best services that folks can use, et cetera. But it's going to come down to, what do advisors value the most? Like one of the ripple effects of the Commonwealth deal was it took out of the market like a firm that I think just did things the right way, candidly. Like they focused on service, on really good technology, on being small, and being high end. And you take that out of the market, you take away a really viable and attractive option for advisors. So it's still like those types of options exist, but the industry fundamentally looks different. So I think what advisors have to think through and work through is like, what do I want in a partner? Do I want like a super boutique experience where I can call up the CEO when I have a question, that I'm one of the top 10 advisors at the firm, so I get preferential treatment? I can go to the conference and I know 90% of the people there, that I have input into the direction of the firm. Like, do you want that? Or do you want a lot of services, a lot of things to tap into at a low or fairly reasonable cost? And you can kind of have both, but the middle ground, I think, has been proven out that that's the most vulnerable right now. Like Commonwealth was mid-size, right? There's plenty that are smaller, plenty that are much bigger. That proved that there's a very active acquisition market for mid-size. Like Lincoln sold to Osaic, Securian, Atria. I'm missing a number of them. Waddell and Reed, like middle, and those go away, either to the big on one side, or they kind of fade off into the sunset, into extinction. Honestly, I'm torn. Like I see it both ways.
If I was an advisor, the one thing that I would definitely do, and no one wants to waste anybody's time, but have your ducks in a row, because I really always, my heart really feels the pull when advisors kind of feel like they're getting transacted. That Commonwealth deal, we never recruited from Commonwealth for exactly the reasons you said. The advisors there were really happy. Like, there's plenty of other, ponds to go fishing. But I feel like if you're in those big firms and you have questions, like, do some educating early so that you know what other models are out there. You've put that list together of what are, my top 3 or 5 non-negotiables. What am I looking for? If I was going to make a move, this is what I would be looking and seeking, because there really is nothing worse than like, I didn't see it coming. That's part of why I love the independent space. It's like your assets are at Schwab or Fidelity. You own your data, you own your clients. Like, we have to wake up every single day and align our time, energy, and passion with our advisors to serve them. If I was sitting in one of those big firms, I would just want to have that, that emergency breaking, the breaking case of emergency glass plan.
I always tell people that optionality is a massively underrated attribute to have. So like there's, a flood of capital providers that want to take a minority stake in a business. Great. It's a elegant solution. Someone wants to take chips off the table and they don't want to sell the whole business. Fantastic. And choice is good. But I think what some people dismiss or they don't put a massive premium on is what happens if that firm sells? What happens if they're not good people? What happens if there's some big change you want to take advantage of? Like to me, having that optionality of, hey, I can leave this firm. I don't have to repaper my assets because they stay with Schwab or Fidelity Institutional. I own my data. I don't have a non-compete or a non-solicit.
Yeah.
I think in this environment where like we don't really know like who the winners and losers are going to be, if it were me as an advisor, I would always put a massive premium on optionality and essentially the ability to bounce out of the situation without fear of reprisal or lawsuits or the feeling of being stuck. Like to me, I would take less money up front in order to preserve optionality because optionality has never been a regret for someone, right? Like it's just like, great, I don't have to take this built-in option, but I have it there just in case.
That's such a perfect tee up for my next question, which is the W-2 roll-up frenzy. Yeah. I mean, I didn't grow up in this business. So, everything I've learned about the RIA and independent space, I've learned at RFG. But I love talking to, obviously RFG's president, Ed Swenson, co-founder of Dynasty. Like Dynasty was so early in the game for building that bridge out of, the W-2 model into independence. I love hearing those stories, but I'm feeling a little bit like what's old is new again, right? All of these advisors, and some of them are succession plan, taking chips off the table while the rest of it. But the private equity firms are obviously like in love with the W-2 roll-up model, and rightfully so. Beautiful. It looks beautiful in a boardroom and in a board deck to own those cash flow streams and own those client relationships. But man, how does this play out when these advisors wake up 5 years from now and they're at a 20% payout and the firm is basically telling them like, no, those are my clients?
Yeah, I agree. I feel like it's there's a disconnect or kind of a dichotomy between the G1 advisor who is either the principal owner or the sole owner of a business, and then the next folks on the cap table or on the totem pole. Whether like I'm a G2 advisor, I own 4% of the business or I own nothing. I feel like I got a good thing going and this firm I've been loyal to, they sell. Most folks, they don't leave when that happens. It certainly could be a moment. I feel like it's a systemic risk for those models. And I think it's also it has been, I think it will be a bigger part of advisor movement is going to be these G2, G3 advisors who are like, hey, like I didn't get a big liquidity event. I didn't get $50 million to in order to get this. I got a de minimis amount of cash or I got nothing. Right. And I might own equity in this firm, but I own like 0.0001%. I think that's the kind of underappreciated component of all of these deals is great for G1, great for providing capital for succession, but ultimately like that next generation isn't going to be able to monetize their business in the same way. They're not going to be able to flex the entrepreneurial muscle. They're just going to be subject to likely 3 or 4 different owners or parent companies over the years. So, I mean, right now it's fought through litigation. It's kind of like the pre-2004 pre-broker protocol, right? Like advisors leave on Fridays. It's a certainty there's going to be a TRO on Monday. Lawyers get rich. Advisors, firms, it's kind of net neutral. Like they win one, they lose one, et cetera. I feel like maybe, I don't know, maybe there's a future in which there's like a protocol in the RIA world, because I do think there's a lot of folks that they want to do better for clients. They want something different, but either because of fear, whether real or unwarranted, they feel stuck. And I feel like if this is an industry where it's about empowering advisors to do best for clients, maybe there's some sort of regulatory action on the horizon that says, hey, like advisors and clients should be able to choose where they work. And we can't kind of rule this through litigation and lawsuits. Like you're seeing now with like Edelman and you've seen with a bunch of firms where advisors, because they are going to get sued, or it's the fear, kind of like you see with like people leaving Edward Jones or firms like that, where whether or not it's true, there's enough fear where it's stopping advisors from being at the place where they think they could best serve clients. And I think it's a risk. I think it's a problem. And I think right now it's not something that's being pondered for the next generation of advisors.
Yeah. We talk about it all the time because average age of an advisor at RFG is 43 years old. So we skew
Amazing.
younger, and so our
Much younger.
our long multi-generational long-term trend is be the premier destination for independent advisors who are looking for that fully supported corporate RIA model. And we look down and you see these, especially when we roll back this to the conversation we were having about AI and being very bullish on our profession starts with people connect with people, right? The human in the loop is what is so vitally important to the health and future of the industry. So it's like you're discounting that human in the loop by we're going to roll you into a W-2 model and we're going to own the client and you're going to get it, be happy with your payout.
Yep.
And so I think we'll have to, maybe we'll do an annual one of these, Lewis, and we'll chart our predictions.
Yeah.
But I think entrepreneurialism is what makes America so special. I'm a builder. I love supporting builders. I'm an entrepreneur. I love supporting entrepreneurs. I could never do anything that didn't have that intersection of talent and opportunity and creating something bigger than yourself, which is ultimately the expression of entrepreneurialism. And I think those advisors who have that deep passion for their brand, for the value they're creating for clients, harnessing the future of technology are going to be like, whoa. I get the call on Sunday night, not, the firm.
It's what it boils down to is different strokes for different folks. Again, optionality is kind of the theme in the industry right now, but it's not my job to cast dispersion on someone who they value, I want to monetize for a massive number today. That's their prerogative.
Absolutely.
Obviously there's medium, long-term ramifications, et cetera. And not every deal works out to be great, but there's a reason why these options exist because there's a lot of demand for them. And they are a great solution for folks who want to monetize their life's work because the dynamic otherwise is these businesses are so valuable and G2 doesn't have the capital to write a $100 million equity check. It just doesn't happen. So it's kind of what the industry has chosen is if you want these amazing entrepreneurs to reap the rewards of what they're doing. And also, I think, provide kind of a proof point or a case study for the next crop up to go and take the entrepreneurial path. This is kind of the double-edged sword. So it's incumbent upon everyone to ask the right questions, think through not just the short term. Because I always say, once the wire hits your bank account, it looks great. But that jolt, that excitement, it wears off pretty quickly. And then you have to wear whatever the outcome of that solution is in perpetuity for the next 10 years, 12 years, et cetera. So choice is good, but you got to be thorough and ask the right questions.
So well said. Okay, last question. I want to bring it back. Personally, obviously, you've stepped into the role as CEO, working alongside your brother in the firm that your mom, who is such an incredible visionary and trailblazer, founded. So you've now gone through a transition and thinking about the future iteration of your firm. So you've walked the walk on what you advise advisors on as they're thinking about their path. What did living through and conceptualizing your own family's firm's transition teach you?
Great question. I would say it gave me a new appreciation for how hard any type of succession is. We were extremely fortunate, right? We had a closely held family business. I think the same way as my mom does, as my brother does, super, super like-minded, same morals, same compass, a lot of trust, obviously. And it's not easy. So what I really learned was just I think an appreciation for any type of succession, whether it's a family business transaction or transition, or certainly if it's an external transition. It's hard. It takes more time than you think. It's not going to be perfect. You're not going to get everything that you want. But if you put in the work, the outcome is amazing. But I definitely don't just take it for granted. Succession isn't just flip the switch. Hey, I want to retire in a month. You're in charge. It doesn't work like that because there's so much knowledge in the mind of the founder. There's cultural norms. There's processes. There's compensation decisions. There's a lot that needs to go right. naturally,
Yeah.
and also a lot that needs to be designed proactively. So that's my big takeaway is it's hard. It was hard for us. We're very fortunate of the outcome and it was all worth it. But I don't take succession lightly. I never did, but now I have a finer appreciation for it.
I've found, building that deep and maintaining that trust with your partners is a little bit like mindset. Like it's, it doesn't have a 24-hour shot clock on it, but it has like a constant drumbeat that needs to really be nurtured. And, I'm sure that you spend a significant amount of time, like, how are we going to carve out the time for partner meetings and what's the agenda? How are we going to check in? How are we going to resolve conflict? How are we going to talk about hard things? It really is like high performing, deep trusting relationships require a significant amount of intentionality.
Absolutely. And it's like, it's not an option to get it wrong, right? For us, it was our family legacy. We have 20 amazing people that have entrusted their professional lives to us. We have thousands of advisors we work with. Like it wasn't an option to get it wrong. And I think that's the way most advisors would feel. Like they have teams that rely upon them, hundreds or thousands of clients in some cases. So you got to be intentional. We worked with a lot of different consultants and it's expensive, but I think it was all money well spent because we're extremely grateful for kind of where we're at now.
Yeah. Well, congratulations. This was just an awesome conversation.
I agree.
Advisors looking for you, how do they find you?
Yeah, but feel free to go on our website or send me a connection on LinkedIn. That's probably the best way. But if you just have a random question, no dumb question, happy to be a resource. Won't charge you anything, no expectation, and everything's confidential.
I love it. Thank you so much, Louis. I love being with you.
Shannon, me too.
Thank you for listening to the Disruption Blueprint podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.rfgadvisory.com or schedule a call on our advisor resources page. And don't forget to click the follow button to be notified when new episodes become available. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Information here may be provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither our guest nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of our guest. They do not necessarily represent those of RFG Advisory, its employees, or its clients. This commentary should not be regarded as a description of advisory services provided by RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place. RFG Advisory is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of RFG by the Commission, nor does it indicate that RFG or any associated investment advisory representative has attained a particular level of skill or ability.